Welcome to Manicflow Money, a simple approach to looking at the world we live in and what could be affecting our asset saving and retirement choices. Here's what we have today. It's an article written by Mark DeCambre, September 5th. He is the markets editor for Market Watch. It's called Here's Why the Dow Plunged Last Week and What's Ahead for the Stock Market. We certainly know that it was volatile last week, and that volatility returned to the financial markets with a vengeance, disrupting nearly an uninterrupted climb to records high for U.S. stock indexes and raising questions about the path for Wall Street as we head into a hornet's nest of challenges for investors. September is notoriously a weak month for investors, and this October has the hallmarks of a very rough patch for Wall Street, especially with the November 3rd presidential election looming. Perhaps the overreaching question is, what the heck just happened to the equity markets? In the 48 hours after the S&P 500 index and the NASDAQ composite on Wednesday just notched record closings, and the Dow scored its first finish above 29,000 since February. So let's look at this from a couple perspectives. First, from the bulls' perspective, not a lot has changed. Bullish investors see the promise of lower interest rates for years to come, further injections of money by the Federal Reserve into various parts of the financial system, along with perhaps another fiscal stimulus from the government. Optimists see the slump that the equity markets experienced this week as just a bump in the road. And I quote, this is Keith Lerner, who is chief market strategist for the SunTrust Advisory. He says, and I quote, since the current bull market kicked off in March, there have only been a couple of pullbacks of more than 5%. And recent bull markets, which he's referring to 2009, 2002, recent bull markets have tended to have 3 or 4 setbacks over the first 9 months. Now, he also notes that the 5-month winning streak of the S&P 500 since August has only occurred 27 times since 1950. And it's a good sign because it tends to imply that further returns are ahead. So investors can view this retreat as a natural corrective phase, one that removes some of the euphoric froth, if you will, from the equity valuations that had far exceeded the metrics that pragmatic investors use to typically invest and compare value against its peers. Some interesting paragraph here citing Dan Suzuki, who is the Deputy Chief Investment Officer at Richard Bernstein's Advisors. And he wrote that particularly a cohort of stocks, including Facebook, Amazon, Netflix, Microsoft, Apple, and the Google parent Alphabet, or what he'll call FanMag, had seen their valuations rise by a dint of multiple expansions or rapidly rising prices, while the other segments of the market had seen earnings estimates fall out of whack with their prices, or distorting the P portion of the commonly used price to earnings metric, P&E. You've heard that. You do that for your taxes. And I'm going to quote, it says, but these two groups of stocks have gotten more expensive for completely different reasons, end quote. He notes that group of stocks rose because of the P prices. Their prices have gone up faster than the E earnings, while most of the rest of the S&P 500 has expanded because of E has gone down more than P. So what he's saying is that prices are inflated. And the first 3 quarters of this year has been nuts. Anybody that's following what's been going on with Apple and Netflix, and especially Tesla, which can probably get thrown into this group. Indeed, during the period when the markets March lows, and early last week, the investors had maintained a pretty good appetite for technology-related stocks and stay-at-home companies. I mean, look what Zoom Communications just did. It's unheard of. So I immediately went to all of the cloud computing software and made a little target list, especially the pre-IPO stuff, because this is like free money. But I digress. I mean, kids are trying to go back to school. We're in the middle of a pandemic, and those best positioned to benefit when the economy eventually emerges from the recession are already showing signs. But a bounce off of Friday's lows, aided by moves into the financials, also was viewed as constructive for the broader market. And I'll quote here, the move higher was mostly led by the financials. So if you saw what happened Friday, basically what they're saying is that it took a huge dip on Friday, but if you saw the end of it pick up, well, the move was mostly led by the 10-year Treasury bond, okay, which has not been something that has been a part at play at all. Yields on the 10-year Treasury bond benchmark rose to 0.72%, marking the biggest single-day rise on Friday since May 18th. It's unusual for yields to climb as stocks are falling, but that's what happened on Friday. So investors usually turn to perceived safety of government debt, driving prices higher and yields lower in times of uncertainty. Well, that didn't occur on Friday. The S&P 500 enjoyed its strongest August in 34 years, gaining 7% and added 2.3% in the first 2 days of September to reach a fresh record high. And stocks are well supported by a combination of Fed liquidity, attractive equity risk premiums, and continuing recovery as economics reopen from the lockdowns. Interesting bull perspective. It's a bump in the road. It needs to happen. This is maybe the third time it's happened in this bull market. And the S&P 500 is performing based on the E side, not the P side. Those are the three takeaways. Now we go into the bear's perspective. Now, from a bearish vantage point, the outlook for stocks looks more uncertain for investors. It certainly may have well laid the groundwork for substantial episodes of turbulence, if not gut-wrenching drops in stocks. And we've all been ready for it, thinking about it. The mini-tech sell-off on Thursday left a lot of scarring. It's not overly surprising that in the New York equities trading, things were relatively muted into a long weekend. I quote, that's from Stefan Ennis, who's the chief global marketing strategist at AXA Corp. And that's on Friday, because September is a notoriously weak month, as I stated. And this October looks just all over the place, ebbs and flows. It has the hallmarks of a rough patch, so he said. And I'll quote Krisenia here, our sense that a smaller resurgence in infection rates is likely to occur in the United States this fall as children and college students return to school and flu season begins. For the first time since April, the S&P 500 closed below its uptrend. This is typically not something that we want to see. So it would indicate that momentum is likely shifting. Negative, negative, negative. Well, off Friday, experiencing the losses into the close, the rally into the close was impressive. Again, we noted it was off the bonds market and the Treasury, the 10-year specific. It could have easily been on the heels of short covering. It was going to be a real bullying day had that not happened. Part of the downturn occurred as two popular companies saw their shares drop. And I mentioned Tesla earlier, who dropped almost 3%, and Apple, who took a pretty big tumble this week. They also just came off a stock split, so you could have seen that going one of two ways. And I think the people that had their margin calls did make some money off those first day or two of the split, Monday or Tuesday and Wednesday. But once Thursday hit and everybody's options were out, like that was it. So what do we have ahead? What's the road ahead? Well, looking ahead, investors turn to the next Federal Reserve meeting, which is September 15th and 16th, which could be important in clarifying the length of the time the interest rates could be held lower, but also what, if any, new quantitative easing the central bank will employ. And here's our buddy, Federal Chairman Jerome Powell, Captain Powell, Federal Reserve, Jerome Powell, in an interview on National Public Radio, which was conducted today in the afternoon, said that the 1.4 million jobs added to the labor market, which was their focus, remember, in August, and an unemployment rate fell from 8.4 to 8.4 from 10.2, which is 1.8%. It's a good sign of progress for the economy. But he also emphasized that progress is going to be slow and they think it's going to get harder from here. So look, if the Federal Reserve is already saying it's going to get wild and we're already prepared for the long run, just get ready. Doubts that the government will soon provide a fresh round of fiscal stimulus for out-of-work Americans has put some pressure on the Fed to do more than just dole out the impact of the economy from disruptions caused by the pandemic. The Fed's role may be the most important feature to whether the stock market's able to continue to make progress higher or not. And as it stands now, there are few alternatives to stocks, with long-dated government bonds yielding around 1% or less. And that's what I'm going to finish on, because it's been a wild 24 hours in the crypto market. Anybody that's been hedging from the stock market into precious metals and or cryptocurrencies understands what Bitcoin just did today. I saw it get under 10,000 twice in the last 12 hours. I believe 9,800, 98.9, something like that. So there's a lot of talk about where the bottom is. But let's also just be a little bit thankful, because as bulls in the crypto market, you don't mind a little bit of that pullback. You don't mind a little bump in the road, because guess what? That means it's still going up. If we bottom out at 10, that's great, Bitcoin folks. There's a lot of altcoins out there. I'm not going to get into all of them right now. We'll save that for another episode. But I will end with this. If you were worried about what you have going on in the stock market, get more conservative. If you think you can transfer it out, maybe that's an option. I don't provide advice. This is just what I do. I've got some assets to deal with. But I can tell you what I did do for sure is I've got a limit order set up for Bitcoin under 10 grand. Because if it's dropping down, it's a buy time. And as they finished this article, there are very few alternatives to stocks with long-dated government bonds yielding around 1% or less. That's because they don't talk about cryptocurrencies that much. It's a risk, sure it is. But I encourage everyone to take a look at what they have, the assets, what the world is providing, the information that is out there. Because if you're hedged properly and you know what's coming up, you will be prepared and you can have time for yourself, to spend with your family and your loved ones. And that's what this is all about. And I'll end with this. Every day is a school day. And I hope that sharing this content will help. And if you've made it this far, just smash that red subscribe button, like the video, try to do more of these things. And I'm a Main Street provider. I am not a Wall Street advisor. Good luck out there.